Good morning, my dear students. Now we have another video which important area of our syllabi, that is 5 heads of incomes. The next very important area, that is determination of residential status or residential status of an SSC. And third point, that is some concepts which are vital while we are dealing income tax. It's very important concepts which may be probable for our exam point of view. Let us see 5 heads of income for calculating tax liability of an individual. We know that an SSC or a person is taxable on his income as per the provision of Income Tax Act 1961. Suppose a person living in India, his entire income is calculated. Whatever may be the source of income, the aggregate of his income or total income is computed in accordance with the provision of the Income Tax Act and calculated tax liability or tax on his total income as per the provision of the income tax slab or rate. For the smooth and error-free calculation of the tax liability of an SSC as per the provision of Income Tax Act 1961, the entire source of income categorized into 5 heads. My dear students, please bear in mind these incomes or heads of incomes are very important. It should remember these points as mentioned in our slides. Question may, let us at we may have questions for exam. What are the 5 heads of income? So students may write as salary, house property, profit and gain, capital gain, income from other source. Answer is wrong. The correct answer for such question is, following are the important heads of income. First one, that is income from salary, income from house property, profit and gain from business or profession, capital gain, income from other source. This is the correct answer. So let us see in detail. First one, that is income from salary. These are all the 5 heads of incomes, income from salary. And second one, that is income from house property. And third one, that is profit and gain from business or profession. And fourth one, capital gain. And the last one, that is income from other source. All these heads are discussed later in detail and calculated the total income under each head and calculate the total income of these 5 heads and then calculate net total income. Then we will compute tax liability of an individual based on the or as per the provision of the Income Tax Act. So in brief, let us see here income from salary. That means salary of a person. It may be basic salary, HRA, rent-free accommodation, perquisites, allowances, profit in lieu of salary, retrenchment compensation. All these are coming under the category of salary. So all these are grouped into one head, that is called income from salary. And another one, that is income from house property. Income generated by way of letting out of house property. There are 2 kinds of house property we have. First one, that is self-occupied house. That is house property which is used for his own occupancy. And another one, that is let out house. There are 2 kinds of let out house, partly let out, fully let out. Leave it. All these things we will discuss in detail in later. So income that is generated by way of letting out of house property is coming under the category of income from house property. And third one, that is profit and gain from business or profession. That means profit from business, gain from profession. Any income which is generated as a result of business or profession is grouped into one head, that is called profit and gain from business or profession. And another head, that is capital gain. Any surplus or income, usually we say that surplus, which is generated as a result of transfer of long-term asset or capital, that is called capital gain. So we can say that any income or any gain which is generated as a result of transfer of this capital asset are grouped into one head, that is called capital gain. While we are discussing these four heads, almost all incomes, all major incomes are grouped in four heads. Some of the incomes are rest, which are not included in these aforesaid four heads. All these incomes which are not included these four heads are included in one head, that is called income from other source. Income which are not included, four head. What are the four heads? Income from salary, house property, business or profession, capital gain. These four heads. So income which are not included in these four heads are grouped into one head, that is called income from other source. These are all the important heads of incomes. Okay. Then next very important thing, very important area as far as income tax is concerned, that is residential status or determination of residential status. This area is very relevant in two aspects. One is, without determining the residential status of an individual, one cannot proceed with the calculation of salary or house property or income from business or profession, capital gain or other source. So the basic background or the groundwork which is required for calculating the tax liability, one should understand how to determine the residential status. So all of you, my dear students, please listen these classes. Determination of residential status and the rules regarding the determination of residential status is vital. Then another aspect, that is, probably for your exam you may have two essay questions. So this is the area which is particular for essay. So all of you please go through this area in detail. Let us see what is meant by a residential status. Residential status means, you can see that a person who is reside in India or based on the residential duration or he may be a resident in more than one country for same previous year. An assessee may earn his income in India or outside India or both place. Which income is accessible in India depends on the residential status of an assessee or an individual. Residence and citizenship are two different aspects. Both are indifferent. Incidence of tax has nothing to do with citizenship. That is entirely differ from residential status. Citizenship, that we know, whereas residential status or residence of a person may change from year to year, but whereas citizenship cannot be changed every year. You please bear in mind, residential status may change year to year, but what we say that citizenship cannot be changed every year. It's a crucial important thing. Then on the basis of resident and assessee are divided into three categories. Please be listen here. Three categories. Basically three categories. First one, that is a resident in India, and another one not ordinarily resident in India, and last one, that is non-resident. From this slide we have four categorization. See in detail. First one, that is a person or an assessee may be or can be divided into two based on his residential status. First one, that is a resident, and another one, that is non-resident. Once a person may be resident and may be non-resident. Two status. Basically a person has two status. First one a resident and another one non-resident. Automatically a resident assessee again can be categorized into two. First one, that is ordinary resident. Second one, that is not ordinarily resident. Please listen. Resident assessee can be divided into two: ordinary resident, not ordinarily resident. So commonly we are saying that person who are resident in India popularly known as ordinary resident. In this view, people have or assessee have three status: resident, not ordinarily resident, non-resident. Even though while we are looking into the theoretical aspect of residential status, an assessee have two capacity. First one basically resident and another one non-resident. Again resident assessee can be divided into two: ordinarily resident, not ordinarily resident. Based on these resident status, his tax liability may change. A liability of a resident assessee is not equal to the liability of non-resident assessee. Whereas in the case of a liability of resident assessee is not equal to the liability of not ordinarily resident assessee. So that is explained in the area of scope of total income on the basis of residential status. This area we will discuss in detail in another slide or another video. Now we move to next important area, that is some important concepts. Many important concepts which are discussed in our previous lessons. Some more concepts we are discussed here. First one, that is casual income. We know that what is meant by casual income. Casual means by chance. So casual income means income of casual or non-recurring in nature. The word casual means coming by chance or coming without regularity. That is called casual income, or income which is occasional or accidental, or something that is happened by accident, or one that is brought about by unknown cause is casual. An income that is produced as a result of chance without a design, plan or a foresight is called casual income. Once again, an income that is produced as a result of chance without any design or any foresight or plan is called casual income. Examples of casual incomes are crossword puzzles, gambling, betting, horse race, winning from lottery, crossword puzzles, etc. All casual incomes are liable to income tax. The next one, that is deemed assessee. We know what is meant by assessee. We have discussed the term assessee in our previous lessons. Then deemed assessee means a person who is deemed to be an assessee for some other person is called deemed assessee. I will give an example for that. After the death of a person, his legal representative will be treated as an assessee for that income of the deceased on which tax has not been paid by the deceased before his death. Or another case, a person representing a foreigner or a minor or a lunatic is treated as an assessee for the income of such foreigner or a minor or a lunatic. This is called deemed assessee. And another one which is related to this assessee, that is called assessee in default. That means when a person is responsible for doing any work under the act and he fails to do so, he is called assessee in default. I will repeat the same once again. When a person is responsible for doing any work under the act but he failed to do so, he is called assessee in default. I will give another example. If a person while making any payment to another person is liable to deduct income tax thereon at source, does not deduct income tax thereafter, or having deducted, does not deposit it into the government treasury, he will be treated as assessee in default only because of he has failed to compile all these formalities. That's why we call it as an assessee in default. And another important term, that is PAN. You know what is meant by PAN. PAN means permanent account number. Income tax authority issue a card carrying 10 alphanumeric character. It's a plastic card that is called permanent account number. PAN is a number which the assessing officer may allot to any person for the purpose of identification. Nothing more than that. The next one, that is one more important thing along with the PAN, that is TAN, tax deduction and collection account number. Is another important terminology which is related to the PAN, that is TAN, tax deduction and collection account number. The next one, that is angel tax. Angel tax means is the direct income tax levied on startups. We know what is meant by startups. Direct tax or angel tax is the direct income tax levied on the startups for the fund raised through angel investors. It is levied on the value more than what is seen as the fair value or market value. It is taxed at nearly 30% rate. Angel tax is levied primarily on domestic investment or funding received. It is clear. The next very important thing, that is substantial interest. This terminology we may use in different situations. I will explain later. Now we will discuss the etymological meaning of substantial interest. Section 2, subsection 32 of Income Tax Act. Substantial interest means The term which is the substantial interest is used in different contexts. For example, in the context of deemed dividend, or in the context of assessment of trust, or in the context of perquisites taxable in specified case under salary. Whatever may be the case, the substantial interest may either in relation to company or in relation to non-company. As per section 232, a person has a substantial interest in a company if, please listen, if he is the beneficial owner of equity shares carrying not less than 20% of voting power. Very important point. A person has a substantial interest in a company if he is the beneficial owner of the equity share carrying not less than 20% of voting power. Whereas in the case of a person has a substantial interest in relation to non-company entity, is considered to have a substantial interest if he is entitled to 20% or more of share of profit. So discussion is very clear. A person has a substantial interest in a company if he is the beneficial owner of equity shares carrying not less than 20% of voting power. In relation to non-company entity, the person is considered to have a substantial interest if he is entitled to 20% or more of share of profit. Okay.